Hi, everyone. How are you? It's great to see you all here. Welcome to the Get Schooled with Stash webinar. I'm Sarah from Stash, Sarah Spagnolo. It's nice to meet you. Nice to see you. I have Doug here. We're going to start in just a minute. We're just letting everybody come into the Zoom room. It's great to see you. Thank you so much for joining this webinar. Give it just another second. So many people here. Thank you so much for spending time with us today. We're so happy that you've chosen Stash and you've chosen this webinar to learn a bit more Investing 201. All right, Doug, you ready to get started?
I'm ready, Sarah. Hi, everyone.
All right. Hi again, everyone. Thank you so much for coming to our webinar today, which is part of our Get Schooled with Stash program, a month of education and guidance just for you. It's your turn to go back to school. Here at Stash, we believe that lessons on money belong in the classroom, and it's a shame that they're not. And so we're fixing that right now with a webinar tonight and last week too. Tonight, we're covering some advanced topics. So thanks to everyone who returned for another webinar. Thanks to those who showed up new. We are so thrilled that you've joined us. As I mentioned, this webinar is part of our Get Schooled in Stash program. Here's a QR code to learn more. It also has a sweepstakes component. Register for this webinar. The webinar that we had last week, you can actually still register and switch your subscription to an annual plan. You'll get it at a discount at 10% off, and you'll be entered to win an entire year of Stash on us. 10 winners, so don't delay on that. All right, we have a great lineup for you tonight. So much to cover. I've invited Doug Feldman, Stash's Chief Investment Officer, to join us today. He oversees our investment strategy and recommendations. He leads the team that provides key market commentary, education, and financial advice. Doug, welcome.
Hi, Sarah. Hi, everyone.
All right, so before we dig in, a quick question for all of you. Here at Stash, we are very interested in talking to people who have found value in their Stash subscription and would be open to talking to us more about why they value Stash. Is that you? Because if it's you, please shoot us a little note in the Q&A that just says simply yes, and we will reach out. Thank you in advance. That Q&A button is also where you're going to ask us all sorts of questions. So I'm going to ask some questions of Doug, and then we're going to take questions from you, and you'll put them in that Q&A section. I see already we have some Q&A already. Amazing questions and a lot of people volunteering to talk to us. Thank you. That's awesome. Okay, so Doug, are you ready to get into the content for tonight?
I am ready, Sarah.
Born ready. All right. We're going to start with investing during election season. Believe it or not, we are exactly, I looked it up just now, we are 41 days and 6 hours from the presidential election. The stock market today hit another all-time high. Are these things connected? Are they not? What should we do to prepare for the election? What should we do in the days after the election? I say here the QR code presented is invalid, deactivated. Good information sharing. Thank you. I'm going to be sure that that's updated, and when we send the recap email, everybody's going to get a recording of this. I'll be sure that that's fixed. So, all right, back to the election, Doug. Talk to us about what we've seen with the historical market trends in investing and in the stock market in the lead up to a presidential election, and what we should do to prepare.
Absolutely. It's a great question. It's a question that I get asked a lot. First off, scary to me that we are 6 weeks away from the election. It's just, I always feel like life is in this hyper speed, hyper warp mode, and we go by so quickly. But to get into your question, markets do become and tend to become volatile around election season. They become volatile around news announcements, like everything, things, there's a reactionary environment in this world. That being said, over the long term, it really doesn't matter so much who necessarily wins the election or who will. Short term, yes, uncertainty may occur due to policy announcements, the election results, but over the long term, really market trends are going to be more influenced by fundamentals, specifically corporate earnings, what economic growth is, interest rates. We had a big interest rate announcement last week. We're going to see a continuation of Fed cutting rates. So it's less about the actual results of the election and more about how is the economy going to respond. Now, we could get into a whole conversation about how the economy responds under different scenarios, but it's more about the economy fundamentals long term and less about the news around the election itself.
So that sort of leads me into a different question, which was the candidate's economic policies, because if it's not the volatility that, or the election itself that drives the ongoing movement of the markets, surely it's their policies that have influence on what the markets do because it impacts the companies themselves. So can you speak a little bit about how the candidates could impact economic policy in this country?
Absolutely. And before getting into specifics of either whether Trump wins or Harris wins, there is a bigger overarching thing that always impacts elections and how the government and the economy functions as a whole. Um, there's a divided government versus single party control. So single party control is when you have Republicans or Democrats winning both the White House and control of both the Senate and the House. So that's single party control versus a divided government where you have one party in control of the White House and another party that control both House and Congress, or one or the other. Generally, fiscal policy is tighter under a divided government because you need to get more consensus in the two parties coming together versus under a single party control. And so generally, we may see in a Democratic sweep that might result in higher taxes and increased spending on social benefits, while maybe a Republican sweep might focus more on extending the 2017 tax cuts with little change in benefit programs. Typically, deficits are larger under single party control because of increased spending and tax changes, while deficit is probably going to stabilize or shrink modestly under a split scenario. So that may play more into it than the individual whether or not Harris or Trump wins. That being said, you did ask about their different policies, and we could talk a little bit about that. There is clearly going to be Trump has been very outspoken about potential tariff increases. So one would expect if Trump wins, and especially if you get Trump winning on a Republican sweep, to see significant increases on imports from China, maybe Mexico, potentially raising tariffs by an average of 20% or something like that. Tariffs on autos from Mexico and EU. And if Harris wins, you're probably going to see tariffs in line with what they are today under the Biden administration. So that, tariffs can have an impact on inflation, and economists have been saying that maybe we'd have higher inflation as a result of that. However, on the other side of it is tax reform, and Trump has spoken very highly about tax cuts and what he would like to do to offset some of that inflationary impact that might come in from tariffs. So it's to be determined there. Again, who wins really is going to depend on if they also control Congress and how that plays out. From a market investing perspective, though, I'm not sure over the long term it makes much of a difference. And sorry to jump around a little bit. One thing I do want to remind everyone, because everyone is, I'm old enough to remember more election cycles, but clearly most people here can remember during the Trump administration, the market was up a lot over the course of 4 years. It did have a hiccup during it for COVID, but was up a lot. And during the Biden administration, the market is up a lot, as Sarah, as you suggested earlier in a phone call. The S&P 500 is at a new all-time high today. So it doesn't really, Republican, Democrat doesn't necessarily matter. It's more about the economy.
Right. So you bring up so many good points that I want to touch on, but in particular, people tend to feel emotional around elections. They might feel very positive, very excited. They might feel disappointed and despondent. Companies that have goods and services that can be impacted by tariffs, such as something like Home Depot and Nvidia, both of them were actually at an all-time high again this week. I just think, how can people think about staying calm in this moment? And should they think about staying calm? I mean, listen, I teased the answer because I know you, but how can people stay calm in this time? And can you explain why you believe that's so important?
Yeah, it really is. So, as Sarah, as you would expect, I'd say, staying calm is incredibly important, and taking emotions out of investment decisions is something that we preach all the time at Stash. It's one of the trickiest things to do. It's tricky for professional investors to do, and it's very, very difficult for everyday Americans when you're out there investing, or everyday, retail investors, when you're investing. So at Stash, we try to focus on taking the emotion out of it. But the best way to do that is to have a long-term plan. Make sure that your portfolio is well diversified so that it is aligned no matter what happens in the markets, and to put in place, whether you're doing, here we preach a lot of auto stash, which is regular investing, because we know that it helps compound returns. You benefit from dollar cost averaging, which we discussed last week. But more importantly, it's a program. So, you say, okay, well, I'm putting away X dollars each week. It's being invested. And I don't care if the market goes down a lot today or it goes up a lot today, because I'm investing. And, we have a lot of people here that work in lots of different professions. It's so much better to focus on your own career, your own family, whatever else is going on in your life, and try to avoid all the noise, and, try to avoid emotion. And yes, this is an emotional time. We're in a heightened political environment where it's particularly emotional this time around, as it has been over the last couple of elections. But to try to avoid that noise and focus on the long-term goals is really, really the strategy here.
Thank you. That's a good parlay into Jonathan's question, which is, will Stash ever offer market alerts? And Doug, maybe you can talk a little bit about our approach and how we construct Stash to help people participate in the activities and the behaviors that we think are best suited for them. One, of course, being auto stash that you just described, which is helping people regularly invest on a schedule and removing the emotion from it. But how come market alerts doesn't fit within our program?
So, it's a great question, and thank you for that question. So at Stash, we really do emphasize long-term investing over trading. And one of the things about having market alerts, an alert being like, something blessed that, oh my God, the market's down 1% today, or the market's up 1% today, or a big news thing, is that could trigger an emotional knee-jerk reaction to a news event. And I keep on going back, and I know we discussed this last week a little bit, but I keep on going back to what happened in the July, August timeframe this year. In late July, the markets hit an all-time high. We're back above those levels now. There was a lot of talk about the economy and what was going to go on, and there was worry about the Fed and what they were going to ultimately do. And all of a sudden, we went through this period, this 2-week period, where the market went out into sell-off territory, and quickly the market corrected, which corrected in parlance means it went down 10% over a very short period of time. And lo and behold, it is rallied back up, and over the last since August, and is now back up above those highs. But it's sort of, think about it. Imagine if you had received an alert when the market was coming down at that point in time. What would that reaction have been to that alert? Maybe it would have been like, oh my God, panic selling. The market's going down. I need to do something. And we're not necessarily of the opinion that you need to be reacting. In fact, you shouldn't be reacting to just market noise. There are plenty of times where you should react. We manage on your behalf smart portfolios where we do make investment decisions when we think that things are happening, but we're not doing that on a daily basis. What we're doing is thinking long term and making adjustments when and if necessary.
Right. Thank you. Satomi asks, how do interest rates affect stocks?
Great question, Satoni. In fact, I think, Sarah, weren't we discussing this earlier today? So interest rates it's a great question. Interest rates in general affect a lot of things, but they impact the economy in a number of ways. When interest rates go up, it's more expensive for companies and consumers to borrow. You may have a personal loan, you may have a mortgage, a car loan, a credit card loan. Your cost of debt goes up, but just like you as an individual, your cost goes up. The cost for companies to borrow goes up as well when interest rates go up. When that happens, spending both at the corporate level and the consumer level decreases, right? And so we're taking pressure off the economy. We slow an economy. The inverse of that happens when interest rates go down, it spurs spending. So that's effectively what's happening. And so, demand increases with spending, and thus we drive the economy. So two things happen with interest rates and stocks. Number one is why, when interest rates are going down, you could read it one of two ways. One is that you could take a negative view, which is that, oh, the Fed is worried about the economy, so they need to cut rates to fuel it. Or they could say, hey, look, we've controlled inflation and now we're able to stabilize and get this soft landing. But ultimately, it encourages corporate spending, which should encourage growth in corporations. Also, and now this is getting into technical math of what interest rates do, and I'm not going to bore everyone here today with the time value of money, but I will say, if you ever hear of, like $100 today is worth more than $100 a year from now. And how much more it's worth really depends on interest rates. When interest rates are really high, it's worth a lot more. When they're low, it's worth a lot less. But you're discounting future cash flow streams backwards. So in theory, if a company was going to be earning a lot of money in the future, lower interest rates means higher stock prices because you're discounting back this at a lower rate, which means that it's more valuable today. That's got a little technical, I understand, but that is another answer when you're actually doing the math on these things.
Thank you, as always, Doug, for that. All right, we're going to move into the next section if we can. And I just want to mention to everybody that has very specific questions about their own account, customer service is going to be getting back to all of you. So feel free to add your questions into the Q&A. If they are not addressed in this session, we'll be sure to get back to you another time. All right, we're going to talk about riskier investments. So there's a whole, and we talked about this last week, which is like investment categories, investment types of it. We talked about investment accounts, but then there's investment categories. So those could include, and I'm going to ask you about individual stocks versus ETFs, overly concentrated holdings, penny stocks and other social media names, meme stocks, cryptocurrency. So can we talk a little bit, maybe quickly, about individual stocks versus ETFs, because we did cover that in a lot of detail last week, and then get into some riskier investments like an overly concentrated holding?
Sure, absolutely. So the benefit of an ETF, which we discussed last week, which is an exchange traded fund, is a basket of securities, like a basket of stocks, where you buy one ETF and you get exposure to lots and lots of different stocks. Versus an individual stock is just one company. The individual stocks generally carry higher risk and can be more volatile, and especially during uncertain times like election times, than overall baskets of them, right? Just if you think about it, there's more risk in one than there is in a diversified approach. Individual stocks in and of themselves aren't necessarily tremendously risky. Some individual stocks more so than others. I know we're going to get in them, but it's more the thought process that investing a very large sum or a very large percentage of your overall portfolio in an individual stock increases risk because you're exposed to that one individual name versus spreading your bets out across various companies, various sectors, various different size of companies and stuff like that. So that's really the issue and why we talk about it. Again, great if you love to invest in individual stocks. Here at Stash, we encourage you to invest no more than 2% of your portfolio in one individual stock, and that's really just to manage risk.
Right. So you sort of talked maybe a little bit about overly concentrated holdings, the 2%, your 2% rule. Is there anything that you want to say about that? And then also, can you connect that to how Stash on our managed account does some rebalancing and what that looks like for people? Because there's a question here from Matthew about positions changing and how Stash supports that when it happens.
Absolutely. Okay, so two great questions. And in terms of concentration, we always talk about diversification and about so concentration is the opposite of diversification. So, here, avoid putting all your eggs in one basket. Even with conservative investments, truthfully, it's like it's better not to be so isolated because the more you have exposure to different things, the less riskier it becomes. In terms of smart, your managed account is a portfolio that is very diversified. It holds low cost ETFs, but across different sectors, geographies, asset classes, which gives you exposure to thousands and thousands of underlying securities. Very, very, very broad market and global. So what we do in terms of, I think the question really was about rebalancing and how that works. Over time, things, move around. I think the S&P 500 this year is up over 20% so far this year, just over that. Whereas bonds this year maybe are up 5%. So imagine a scenario where, well, I'll take it in a very, very, very simple scenario here. Imagine we said, hey, we want your portfolio to look 50% stocks and 50% bonds, right? So half and half. Well, imagine if one of them was up 20% and the other one was up 5%. Well, all of a sudden you would see that instead of them being equal, one is up a little bit more, and so you have more, you've gone from maybe 50-50 to now you're at 55-45 or something like that. So at Stash, what we'll do is we will try to nudge you back to that 50-50 allocation by selling off some of that large overperforming sector or stocks, selling those down to buy some bonds and even that out. And we do that at least once a year, but on a quarterly basis, we check to see how big that is, because small movements, okay. When the movements get too large, we do a rebalance.
Charles and a couple other people actually are asking, what is the difference between an ETF versus a mutual fund?
Great question, Charles. They are similar, but slightly different. but the concept can be very similar. So, and let's take them at the core of an easy one to explain. There are ETFs that invest in the S&P 500. Again, the S&P 500 being an index of the 500 largest companies in the US. There are ETFs that do that and mutual funds that do that. Both of those will give you the exact same exposures. ETFs, though, trade throughout the course of the day. So you could buy and sell them throughout the day. Mutual funds have a pricing at the end of the day. Historically, and while I just gave you the example of two passive or things that track index, historically, more mutual funds were active, meaning they have fund managers that are actively picking investments, where ETFs are passive. Over time, we now have both active and passive on both sides, but still ETFs tend to be more passive. Mutual funds tend to be more active. And typically, not in all cases, but typically, the fee structure on ETFs is much lower than the fee structure on mutual funds. Now, for everyone out there, the fees on these, because I want to make this clear, are embedded within the fund prices themselves. You don't pay an extra fee to own them on Stash, and it's the same, whether or not you own a ETF at Stash or you own it at Fidelity or Robinhood or wherever you own it. The embedded fees in that thing that the fund managers get paid is embedded in the price. And by the way, it's a de minimis amount, but that's not a fee that's coming out of your pocket. Well, it ultimately does, but it's not directly coming out of your pocket.
All right. Allie wants to know, why does Stash not allow investments in indices like the S&P 500? So maybe you can correct that.
Okay, thanks, Ali. So you do actually. So the S&P 500, great example. You can invest in the index itself. You can't invest in the index itself anywhere. What you can invest is only in product that mimics the index or matches the index. The index is just a quoted thing, and then the different fund companies have put out products that you can invest in. Here at Stash, we have ETFs that capture the S&P 500 and many other indices. But for example, at Stash, we have a ETF which has a ticker IVV, which we call here Match the Market, but it really is the iShares Core S&P 500 ETF. There are also some other ETFs by Spider, the S&P 500, SPY. There's a Vanguard one. We have several actually S&P 500 ETFs on the platform, all very similar, but we have ones that capture all sorts of different indices. So you can actually invest in those on Stash platform. And our recommendation is always to invest in index type ETFs rather than to try to pick and choose your own stocks, because that's a little bit more challenging.
And we're going to get into some of that research in a minute if we can move on, and I will, but I think maybe our next webinar will have to be about ETFs and mutual funds, because there are so many questions here. Let's combine the next three riskier investment categories and get through it a little bit quickly, because these also would be their own session and have been here at Stash. But penny stocks, other social media names, and then meme stocks and YOLO.
Okay.
Deep breath.
Yeah, this is I take a deep breath because I've just seen so many people lose money here, and it pains me more than anything else to see people try to make money investing off of either meme stocks or stuff that you see on a message board, or some influencer on TikTok is talking about some stock that you should buy. Generally, these are not where you're going to be making money. And generally what we see people do is their prices are typically driven by social media hype or message board hype rather than fundamentals, and that results in significant losses, because it's almost like a game of, I don't know if people still play hot potato or musical chairs when you're a little kid, but like when the music stops, it's all over, and these things become very, very, very risky. And it's one of the reasons that we've avoided, putting penny stocks on the platform, because of the risks involved in them. There are some names on a platform that have gotten caught up in these meme stock crazes in the past. Again, this is not something we're encouraging investment in, though.
Cryptocurrency. Can you speak a bit about our opinion on crypto?
Sure. So again, cryptocurrencies, very speculative, highly volatile. Volatile meaning that they move around up and down a lot. Remember that investing is not gambling. We don't espouse gambling. Not that there's anything wrong with it. I personally do gamble, but not with an amount of money that I could afford to lose. It's always a small thing. In terms of something like crypto, if you want to invest, okay, you go for it, but just keep it as a very small percentage of your overall portfolio. If you have a fundamental belief that Bitcoin will be $1 million of Bitcoin in 20 years, okay, great. Buy it, hold it, but keep it very, very, very small, because of the risk that we wake up tomorrow and a cryptocurrency is down 50% or 75%. And that's, that I think is one of the things that is out there. Again, do your own work. Don't assume anything that you're going to retire off of doing this. If you think it's a great investment, go for it, great, but don't invest in anything just because you think it's a way to make a lot of money very, very quickly, because those typically don't work out well.
And Doug, maybe it's worth talking a little bit about how Stash was founded and what we're all about. And I can step in for a second and just say, as a registered investment advisor, we're here to help hardworking Americans invest and save so they can achieve their goals. And so all of the advice that Doug gives is actual advice from a registered investment advisor. The app is able to offer that. And for that reason, some of these penny stocks or crypto are not on the platform because we're here to help people grow their wealth over time if we can.
Yes. Well said. Thank you, Sarah.
You're welcome. All right. Let's move into a little bit of stock research. I think, as you've talked a fair amount about, we have things like auto stash, very important in helping people invest in an automatic fashion, as well as our diversification score, which helps people keep their portfolio diversified. Smart Portfolio, our managed account, to help people also stay diversified and sort of set it and forget it. But some people still are really interested in doing some stock research on their own, as they should. And so can you take us through a little bit about how you think about that? You have so much experience over the course of your career. Let's start maybe with company research. So things like a PE ratio, EBITDA, like all of these terms that are thrown around. Can you help people understand what they mean and what you look for when you look to invest in a particular security?
Sure, absolutely. So also I'll just, take a step back. Earlier in my career, this is, I spent many years on Wall Street investing and worked, managed money at a very large hedge fund for years. I've invested in many things, but it's a lot of work and it's, fun and rewarding. But what I love to see is that when someone buys a stock, that they are doing real fundamental research. And what does that mean? What does that look like? And what are you mentioned some metrics, and I'll get into those. But that means understanding what is the product or service offering of the company, understanding the company's leadership, their strategic direction, understanding their competitive advantages and disadvantages, understanding their financial health, and that in order to do that, that requires work. It means going to the investor relations website of the company, reading their quarterly earnings reports and annual earnings reports, looking at industry presentations. If you have access to some sell-side research, you may want to get a research report to understand that a little bit better. And then you do some fundamental work on the financials of the company, and you look at certain metrics like a PE ratio. PE ratio is a price to earnings ratio, is one, which is basically the price of the stock as compared to the earnings per share of the stock. And you could look at that and you could compare that to where that company traded historically. You could compare that to other companies in the industry. Some companies trade off of PE ratios. Other companies trade off of a metric like price to sales, or a enterprise value to EBITDA, which is a earnings before interest, tax, and depreciation. But there are all sorts of metrics that look at, and what you have to understand is, you have to do the analysis to understand what is the multiples that your company is trading at. And then you really have to compare those metrics to industry peers to really gauge value and growth potential, to see, hey, I'm buying XYZ Corp that, is in a certain industry. You compare that to ABC Corp and, which one's more valuable, which is not. Why are you buying this? What is the strategy? The other thing is, I would say, is that with certainty, when you buy, you make money investing in a stock twice. You make it the day you buy it and the day you sell it. So when you do buy, you should always have a target price for the stock, and you should have a thesis for that stock. Why are you buying it? And then over time, as it approaches your target price or the fundamentals, the thesis changes, you should be reevaluating your holding in it.
Thank you for that comprehensive answer. Sushu wants to know, how about investing in an IPO where not much is established? For example, Rivian when they went public.
So a couple of things I want to talk about, because this is a great question. It's a misunderstood question as well. There are two things that when someone says investing in an IPO, in order to actually invest in the IPO at the price that the company goes public at, you need to be affiliated with a firm that gets access to IPO shares and will hand you IPO stock. What most often happens is for retail investors is that they're buying shares in companies after they've gone public. Now, maybe minutes after they've gone public, but they're generally not getting that best IPO price. They're getting a price there afterwards. IPOs, and exactly for the reasons you enumerated, because there isn't as much information about it, there's not as much trading information, it's new to the company. While there is financial disclosure and a ton of it, you don't really have a great sense for the company. So they tend to be more volatile than more established companies. So that, that is it's a little bit riskier. Again, not opining as to whether or not one should invest in recently IPO companies or not. It's more hey, just understand that generally those companies have more risks associated with them, especially in terms of their trading dynamics and where you'll make money or not, versus more established companies.
What about using professional investment managers? You kind of talked about being affiliated with somebody that's going to help you in a certain scenario with IPOs, but how do you think about that as it relates to stock research?
That's great. So first off, what is a professional investor? So professional investor, manages money on behalf of clients, whether that's a mutual fund, which someone asked about before, or an actively traded ETF, or a hedge fund or some other asset manager. They do things very differently than a retail investor do. They have a lot of access. They have access to teams of analysts. They have advanced research tools. They usually have direct conversations, communications with management teams. And that puts them at an advantage relative to retail investors that have really limited information and resources. So, there is a disadvantage when you're a retail versus professional manager, but your question was, hey, should you give money to a professional manager? I think there's a couple of things. So here at Stash, in our smart portfolios, we are professionally managing smart portfolios on your behalf, but we're not actively picking and choosing stocks. We're picking overall portfolios. But you could invest in an active mutual fund, not at Stash. We don't offer mutual funds, but you could invest in an active mutual fund. You can invest in some active ETFs. For example, we have, and this is not a recommendation to buy these, but they are on the platform, the ARK funds managed by Kathy Wood, the very, very large ETF family that are actively managed. So there are, and we have many other actively managed ETFs on the platform as well. So there are opportunities to invest where it's being professionally managed for you. Generally, those do come with associated higher fees, again, embedded within the price, not explicitly there, but it just something to consider.
And Smart is not an additional fee in addition to your subscription price at Stash.
Exactly.
Thomas wanted to know in particular, can I combine Smart Stash, which I assume he means Smart Portfolio, with picks of my own?
100%. Was that Thomas that asked that? Thomas, thank you for that question. Thomas, I will tell you a couple of little insider secrets here. The vast majority of new stashers are choosing to go with Smart off the bat. That being said, I think the majority of overall customers have exposure to both the personal portfolio, where they're picking and choosing their own investments, and Smart. And I think that's it could be a great, interesting, fun way to invest, especially if the majority of your money is in Smart, which is acting as a ballast for your overall portfolio. And then maybe you say, hey, look, I want to invest in these certain companies or sectors with some other money, understanding that there might be more risk involved in that. But overall, you're creating a great overall holistic investment portfolio. So a lot of our customers do that. a lot of our customers also choose to go directly 100% smart, and there's many customers that are also doing 100% self-directed, picking their choosing. But the combination of the two is a lot of stashers are doing that and doing that successfully.
Amazing. All right. I'm going to open it up for just one or two other questions if anybody wants to submit some. Timraya wants to know, what are your top ETFs for the next 15 to 20 years?
Smart portfolios. Sorry. That's I didn't mean anyway. Over time, we believe in a couple of things, which is that the markets tend to go up over time. That when you have a long-term investment horizon, being invested for that long period of time makes a lot of sense. We do believe in being diversified as well. Like, we don't know what tomorrow will bring, but over a period of time, and we build portfolios like smart portfolios, which invest in ETFs for that long term. In addition, though, the question is, if you wanted to go into your personal portfolio or another account to pick an ETF, we highly recommend focusing on these broad market ETFs that have very low fees in them, that you buy them, you could hold them for long periods of time. They offer diversification in and of themselves, and over time, you don't have to necessarily pick the winning sector because you're getting exposure to all the sectors, and you'll have the winners in there, and over 15 years you should compound really nicely.
Thank you, Doug. With that, we're going to wrap. I want to ask everybody again, if they're interested in talking to us about the value they find in their stash experience or in your stash experience, please write yes in the Q&A, and we'll be sure to get in touch with you. We'll also be sure to answer your questions for those people who sent them and we didn't get to your questions. I want to share that the information we shared today is purely educational. We're not providing any financial, legal, tax, or investment advice. Do you want to make sure your friends get access to webinars like these? If so, this QR code does work. We checked it, and you can refer your friends to Stash. You'll both get $20 to invest or to spend as you wish. Next slide, please. As a reminder, thank you for joining. Everyone who registered today and who registered for the webinar that we had last week and switches to an annual plan at a 10% discount, or already has an annual plan, you're entered to win a year of Stash on us, 10 winners. I want to thank you all for being Stashers. I want to thank you for taking the time to spend your evening or your afternoon with me and with Doug. We really do appreciate you being here. Thanks for getting schooled with Stash, and we'll be back soon. Thanks, everyone.
Thanks, everyone.
Have a wonderful day. Bye.